I'm Adam Myers, and I lead the distribution team at Pengana. Thank you for joining us for this fund update with John Moog, the portfolio manager of the Pengana Global Small Companies Fund. This morning, John will explain how his team responded to the risks of the pandemic and then how they were able to take advantage of the opportunities as the government stimulus took hold and the market started to recover. He will also update us on his current market expectations and the positioning of the portfolio. During the presentation, if you have any questions, please enter them into the question box, which is accessed from the icon on the bottom of your screen. We will get to them at Q&A at the end. John, over to you.
Great, Adam. Thank you so much for the introduction. I'd appreciate all of you joining me here early on a Tuesday morning or late on a Monday afternoon over here in the US. Today, as Adam mentioned, I would like to accomplish a few things. The first is I'd like to chat a little bit about the recent performance and the environment that we've been operating in. I think it's been a pretty unique environment, and would like to just chat about what we've been seeing and what we've been thinking through. And also kind of moving from kind of a period of a significant stimulus into a period of I'd like to call it a more normal operating environment for the investment world, and how we're positioning the portfolio for that and what we expect over the next, let's say, 12 to 24 months. And last, I'd like to review, just give a brief review of many of you. I've met with many of you and seen many of you, but I'd like to just give a brief review of our process and go through some trade examples to really highlight some of the things we're seeing in the market and the examples of the kind of investments we're seeing out there today. So we'll start with I just want to give a brief introduction for those of you who don't know me. My name is John Moog. I'm the CIO and portfolio manager here at Lizard Investors. I've been working with David Lee, who's not on the line, for the better part of 13 years now. We've been with Lizard since the inception of the firm back in 2008. And with Pengana, we formed a true partnership similar to their other economic models, and are really partners. We view ourselves as partners in the business. We have had the same investment philosophy, the same process for the last 13 years, investing in the small cap international space, which we think is a unique but very interesting investment area. And we think it requires a little bit of not only institutional knowledge, but a unique process. We are value biased investors. And we've really focused our entire process around this global small company space and how to attack the area. And what the output really is from a portfolio perspective is a portfolio of very high quality businesses with good downside protection and significant ability to compound over time. We're cash flow based investors. Our investment horizon is 3 to 5 years or longer. And we run a reasonably high conviction portfolio, typically with top 10 representing about 30 to 40% of the portfolio and about 50 names across the entire book. And I think many of you in the audience, I just want to briefly talk about what some of the advantages of investing in the global small cap space are. I think it's a unique space for, we see this in every market we invest in is there's a significant home country bias in almost every market we invest in. And really, I think one of the things we'd like to highlight is the global small cap space is truly a nice performing space. You see it outperform here by almost 4% a year over the large caps over a long period of time. But I think the more important question we get asked a lot is the space inherently risky? You have big drawdowns, all that type of thing. And I think we really want to point out, not only do you get much higher returns, but the risk-adjusted returns are quite a bit better than the global large cap space. Here, I think the easiest way to see that is Sharpe ratio, but the simple way to think about it is you get higher returns with pretty limited incremental risk. And we think that's one of the things that a lot of investors should think about when they're allocating to global equities overall. So what does the market look like? What's the market look like the last 12 months? What have we been investing in, and how have we been dealing with what I think has been really one of the most unique periods in my career? I've been investing since 1999 professionally, and over the last 20 years, you've seen massive. You've seen the GFC, you've seen other the tech meltdown in the early part of the 2000s. But this has really been a unique period driven by a non-financial risk, and it was really interesting to see how it played out. So I'll just talk about a little bit about what we've been seeing over the last 12 months, how the fund responded. Coming out of COVID, I don't think anyone would have expected the what we saw, which was massive government liquidity, really, and along with the adoption of and the rollout of vaccines, and the world responding very, very actively with vaccines and in a positive way, really causing animal spirits to come back in a really meaningful way. And so what was a distressed market in March, April last year quickly turned into a rapid, I would consider a momentum market with significant pockets of really speculative investment. And I think we've seen that with the real growth in the SPAC space here in the United States, as well as the growth in the crypto world, and this massive, what I call a massive run up in, let's say, the high growth, disruptive consumer tech businesses. There are several in Australia you're familiar with, but some of the valuations in the internet-facing consumer-led businesses has just been really staggering for us. And then I think the last piece that we're really starting to notice is inflationary signals really starting to pop up all over the world. I'm sure you guys are seeing that. Construction costs are up dramatically. You're really seeing commodities start to rally all over the world, and so now we're in I think we've been through this big period of reflation. And how did we respond to that? How did we respond over the last 12 months? What did the fund do? I think for us, we really believe firmly in talking to companies when we're going through periods. And typical for us is about 400 to 500, let's say 450 management interactions a year. Over the last 12 months, we've talked to over 700 management teams. And I think given the period of volatility, you see elevated level of turnover in the portfolio, as we've really seek to take advantage of the sell-off that occurred last March, April, and May. And we really repositioned the portfolio at that point. And then you're starting to see us begin to reposition the portfolio again. And I'll talk a little bit about what we're doing and what we're seeing. But we're really starting to see, so we've seen an elevated level of turnover the last 12 months. We are expecting that to start to taper off, and the portfolio is starting to reconcentrate it as well again. So we'd expect turnover to start to trend back down to our historical 30 to 40% rate. We'd also expect our portfolio to got up to a peak of 70 names during the crisis, start to trend back down to sort of 40 to 50 names, and the level of concentration to kind of tick back up. Top 10 are currently representing about 31% of the book, but we'd expect that to tick up a little bit over time. And I would say that that's really a signal for us that we're returning to more of a normal operating environment. In terms of what's driven the book and how the book actually performed over the last 12 months, the book is up almost 38%. We're up over 60% since the March lows in 2020. And I think one thing I'll touch on here, you can see some of our large performers: Kindred, Canby, Fiverr. These are all businesses, two of which are in the consumer-facing internet sports gaming side of the world. Fiverr is a online job, effectively short-term temporary job project business, really driving kind of a marketplace model. And those businesses are the ones I was talking about have gotten extremely expensive. So three of our top 5 performers are no longer in the portfolio. We've exited those positions and replace those. And I'll talk a little bit about that moving forward in the presentation, but I just wanted to highlight that in that it is something we're seeing across the book. It's sort of moving out of those businesses that have really performed dramatically well from a price perspective and moving the portfolio into more attractively valued areas of the market. So, as I mentioned, I've talked about this current environment a bit and what exactly are we seeing in the current environment. From our perspective, the current environment really is represented, it seems to rhyme a bit with what we were seeing in the late 90s and early 2000s. And you've had this really bifurcated market where a large portion of the market has been completely ignored the last couple of years. And you've seen a pretty small segment of the market dramatically, drive performance really for the entire, for a lot of the indexes. And I think we've seen that really, in the growth space for equities, as well as some of the other asset classes I mentioned, as you've got Bitcoin and all the like. And so from our perspective, you have this situation much like you did in kind of late 90s, early 2000s, where you have segments of the market that are extremely expensive. We're seeking to avoid those. But you also have a lot of segments of the market that are very attractively valued, that are out of favor, and we think are actually going to perform quite well through the next 3 to 5 years, much like you saw many segments of the market perform well in that sort of 2001 through 2003 period. And I think that gives us a lot of optimism that there's still quite a bit of value out there in the market. And I think this chart is an important one. Here it really just shows growth versus value. And you can see kind of from December 19 through kind of the peak towards the end of 2020, just growth drove all the upside in the market. Growth got much more expensive relative to value, but you have started to see that begin to retrace. And that's something we would certainly expect. And I think, why we believe that will continue. We finally started to see some catalysts emerge that we think will really transition the world away from some of these higher value businesses into a more broader, let's say, healthier investment environment in our view. I think inflation, inflation and what will inevitably be the government's starting to have to wrestle with how to deal with what's been very loose monetary policy will be an important one. And I think either governments are going to be forced to tighten, or as inflation starts to trickle through economies, we think that's going to be very negative for some of those highly valued areas, but not so negative from some of the more out of favored areas of the equity markets. You're also seeing fund flows starting to reverse. And obviously that's a very real-time indicator of where investors are allocating capital. And I think you can see it, the poster child is, the ARC funds here in the US, which are the ETF funds holding a lot of the, some of the names I'm talking about, Tesla and the like, have really started to roll over. You're seeing very significant outflows. And so we think that's a real warning sign and another thing that could drive that let's say change in the marketplace that we're seeing. And then I think the last piece that gets us, that really has us paying attention is the fact that vaccines are really being rolled out quite effectively in a lot of developed markets, and the pace may be a little different in some of the developed markets, but I think the world is, in a lot of the developed countries, the world's on a pretty healthy path to life returning to normal. We're seeing it here in the US, we're seeing signs and dates in Europe and in other places. I don't think the same can be said for some of the emerging markets where we still see we don't really see a path to a resolution to COVID yet. And so we see, and from that perspective, a lot of these more value-oriented names are in developed Asia and developed Europe, where we think there's really big pockets of equities that have been ignored. And some of the places in emerging markets where there's been more of a rally in the growth names, we think are a little more exposed to just, frankly, slower economic growth given the slower vaccine rollout. And this chart, I think, is a good indicator. It kind of signifies what I'm talking about here. Similar to the growth value chart, here you can see a chart that just sort of shows international. At the top of the chart is where non-US equities outpace US from a performance perspective. And the bottom part of the chart is where international lags US equities. And you can see this is on a rolling 10-year basis. So these are very long-term trends, but I think it's important to note in our view that the US has outperformed for quite a long period of time. And those catalysts I was just talking about, I think, are really starting to form where you could see a pretty meaningful reversal in terms of international outperforming the US. And that's something we haven't seen for a while. It's been embedded in our portfolio for a while, but I think these are the first times you're starting to see a catalyst of people really starting to understand how much cheaper non-US equities are relative to the US and the opportunity set there. So, given that backdrop, I'll just talk a minute about a minute or two about how we have positioned our portfolio and what we're seeing, and try to make it a little more tangible in terms of what we're really doing. Our North Star is really investing in high quality businesses. So we continue to find very high quality businesses at reasonable prices that will continue to compound capital. We invest in the small cap universe where we call it the orphan universe, where there's just a lot of high quality businesses that are under the radar screen, and we tend to spend a lot of time investing in those businesses. That continues, but I would say there's been a slight shift in terms of the industries we're looking at. We're finding more value in non-tech, non-software businesses right now in terms of actually pricing. The other thing we're seeing is some clear catalysts for value creation in the value space, and I think this is the first time we've seen this in a few years. we've had three companies in our portfolio get taken private recently: Equinity in the UK, Aero Global in the UK, and 51 Job, which is a US listed Chinese business. All of three of these businesses, in our view, were just too cheap, and you're starting to see the market actually pay for, let's say, high quality businesses with very high free cash flow yields. The market, the private markets are starting to understand how cheap these are as well, and we think that will be a catalyst for some of the things I'm talking about, which are just names that have been ignored, high free cash flow generating businesses that are out there in the open, and we're starting to see some value ascribed to those, not just to really high revenue growth businesses. So you've really seen us be aggressive about actively rotating out of some of these successful investments we've had and getting into some of these businesses where we think they're very good businesses that will compound value, but at much more attractive valuations. And I think some examples of that for us, we've exited businesses. Green Thumb, which is a cannabis company listed in Canada, but operates in the US. The cannabis space has just been extremely hot. It was a fantastic investment for us, but you've really seen, we're a bit worried about that space from a valuation perspective. FlatEx is a online discount stockbroker in Europe. Obviously had a phenomenal 2020 with all the personal trading that was occurring. Kindred, similarly in the internet sports gaming space. All of these businesses really benefited from COVID and got very expensive. And so we've rotated out of those names and are investing in other businesses where you're seeing, where we just think we're getting much better value. And so, Intertrust, Scheffler is an auto business in Germany with almost double-digit free cash flow yields. Intertrust is a business in the Netherlands that is a very recurring, high free cash flow generating business, services businesses, long customer relationships, again, trading at 7, 8, 9% free cash flow yield. So we're seeing a lot of opportunity to invest in businesses where we think the value is very good and there's some compounding that will occur, and really rotating out of the riskier side of our portfolio where valuations just got quite a bit extended. So how does the portfolio actually look? And it's changed a bit since the end of April as we continue to rotate. And so you would see at the end of April, we had 60 positions. Top 10 represented 31% of the book. You've actually seen that top 10 tick up a bit over the last month and a half. I guess we're almost a month since the end of April. You've seen positions come down to 56, and I talk about really that reconcentration of the portfolio. Here you can also see our regional exposure. We are, again, I mentioned very overweight Western Europe relative to the index, and that's really based on where we're finding value, and underweight North America, where we think the US in the small cap space is quite expensive with some of the things that I talked about earlier in the presentation. And the fund continues here in the market cap size. The fund continues to be very much weighted to the small cap end of the space. That is just something that's going to be inherent in our portfolio because that's really where we think the alpha generating opportunities in the space is, and finding those sort of sub $1-2 billion names and letting them grow over time into bigger companies and compounding value for us. And in terms of our industry mix, we obviously are like most other Pengana funds, we are index agnostic, but you get a good broad representation of some of the sectors here. We obviously are underweight healthcare, real estate, utilities, and those are just generally areas of the market we tend to stay away from, given that we are very business model focused. And a lot of those industries, we struggle to find business models that meet our criteria. So now I'll move on to just chatting a little bit about how it is we operate in a universe that's 50,000 companies. We get a lot of questions about how do we source ideas, how do we do research in this space, and how do we actually put together a portfolio of these quote unquote high quality, attractively valued businesses. And so from our perspective, I think the sourcing engine of what we do is really unique and probably the most interesting piece of what we do. So I'll just spend a minute talking about that. We, rather than use screens, really have built up our knowledge base in this, let's say, orphan universe, really from the bottoms up. And I'll start here on the watch list on the left-hand side of the page. I think it's important to remember, we've been doing this for 13 years now, and we've been meeting with 350 to 400 to 500 companies a year. Obviously, it was 700 in the last 12 months, but we meet with a lot of management teams. And over time, we've really been able to identify a significant chunk of businesses that meet our quality criteria. And so if we've met, let's say, 3,000, 4,000, 5,000 businesses over time, about 400 of those businesses are high enough quality for us to invest in. And so we have formed a watch list of businesses that we would love to invest in, really through our institutional knowledge. And that's been meeting with these businesses over time, flying to Japan, flying to all these various places and getting to know these businesses. And really that institutional knowledge of where we want to invest in the companies that meet our criteria is really critical in enabling us to fill the portfolio with those high quality businesses and really driving the portfolio in times of distress. So it enables us to move quickly, like we did in COVID, to reorient the portfolio and find those high quality businesses that have really sold off. The other place, we're always looking for new ideas. And I think this is the other interesting piece of what we do. We're applying a lot of what a traditional value investor would do in terms of sourcing ideas, but we're just applying it to a slightly different universe than most investors look at. And so for us, we are always looking for new businesses, and we're looking for situations where there is a likely misunderstanding in the marketplace. So we're looking for situations where there's lack of institutional support, no sell side coverage, spin out, reorganization, a country out of favor, a region, an industry out of favor, new management's come in, something that's created a misunderstanding in the marketplace. And when you combine that with the lack of institutional support in the small cap space, we think you can find situations where you have very attractive companies that have just become totally ignored by the market because of some of the circumstances they've been put in. And through those two sourcing mechanisms, we attempt to build a concentrated portfolio of high quality businesses at attractive valuations that is really going to compound over time. And I've mentioned quality businesses a few times, and I want to spend a few minutes talking about why we think investing in high quality businesses is so important in the small cap international space, or the small cap global space. And then I'll get into kind of how we define a high quality business. But I think first and foremost, why we believe high quality businesses are so critical in investing in this space is that we think it does two things. The first and foremost, which is great, which is these high quality businesses compound value through both downturns and upturns. And so from a compounding perspective, we think it's the best way to achieve long-term returns in our space. But I think the second thing is really important too. Our space has more risk, carries more volatility. And we think one of the ways to really protect downside in our space is through investing in these high quality businesses. And as I said a moment ago, these high quality businesses are exactly where we think these businesses tend to take market share and actually grow and improve their market position in downturns. So we think really from a long-term capital preservation standpoint, these are the businesses that are really built to withstand downturns, to protect your capital and actually grow your capital through these downturns. And so we think that's really important in what we do. And I think it's a slight difference in how value investors think, but we think reversion to the mean is a great concept in large caps, but we think in small caps, having really high quality businesses is really critical in protecting your downside. In terms of how we think about downside protection, how we think about high quality business, we really look for four things in a company that are really critical. The first is a business model that we think is sustainable. So we want a business that is going to earn high returns on capital throughout a market cycle. But more important than that, we really want to understand what makes this business special, unique, what's the customer value proposition it provides so that it can really continue to take market share and earn those high returns for us for a long period of time. The second thing we want is a balance sheet that is self-funding. So we want a business that isn't going to require to raise equity in a downturn and really dilute us. And secondly, we want a business that will be able to self-finance its growth with these high returns on capital. So balance sheet to us is also very important. The third thing we think about is management team. We want a management team that's really aligned with us. Here at Lizard, we eat a lot of our own cooking in terms of investing in our funds personally, and we want management to be the same way. We want management to be have a lot of skin in the game, both on the upside and the downside, and really be aligned with minority investors. And the fourth piece, and I think this is important, is corporate governance. We invest in a lot of places in the world where the minority shareholder protections are not as high quality as what you might experience in many Anglo-Saxon jurisdictions. And so from our perspective, we spend a lot of time making sure the company treats its minority investors as partners. And so those are the four pieces for us that really define a quality business. And then of course, the fifth piece to make an investment is valuation. And so for us, these are really the key drivers of what we're trying to find every day and get into the portfolio. And I just want to talk about a few examples of the types of businesses we find that we think are really interesting, and back to the concept of investing in these smaller businesses that are a bit under the radar. I'll start with TFI International. TFI International used to be known as Transforce. It is a trucking business in Canada. And of course, when I say a trucking business in Canada, that sounds very generic. It sounds like it's really a business anyone could do. But I think what's really impressive about TFI is back to this business model concept. This is a true, you have a management team that started this business with the concept of building an asset-like trucking operator. And what you've seen is not only them creating the lowest cost position, but also the asset-like nature of it has allowed them to earn 20% returns on capital over the last 20 years, which is really an incredible feat. And so from our perspective, what we love about this business is they've created a fantastic model in what is otherwise a commoditized industry. And what it's also allowed them to do is to go into and buy other small trucking businesses or divisions of trucking businesses. The most recently from UPS, they bought a small, a reasonably big division for them, but a small division of UPS's trucking business. And they can turn these businesses around given their business model, where a lot of other trucking companies just can't afford to do it. So you not only do you get the 20% return on capital, but you get the turnaround economics when they invest in these high quality, or these businesses and turn them around. And really, this goes to being tied to the management team. The CEO here has been here for 20 years. He's a top 5 shareholder of the business. He has, again, been generating this 20% return on capital for a long period of time. And he has compounded the value to where his own net worth, he's got almost $400 million Canadian of his own net worth in the business today. And that's really his only asset. And so again, we love the concept of a high quality business with a competitive advantage and an aligned management team that's going to continue to execute on it over time. The other thing we love here is this is, again, back to the alignment and business model. The CEO, Elaine, keeps a very strong balance sheet because he knows he's going to be able to buy businesses in times of distress, and he needs a good high quality balance sheet to do that. And so again, back to kind of that concept of reinforcing, a business model, reinforcing a balance sheet, being reinforced by a management team. This is exactly the kind of situation we're looking for. And so, TFI has been a fantastic long-term investment for us. It continues to be a good investment, and I think a good example of kind of the compounding that you can that some of these smaller companies under the radar can achieve in niches of the market. Similarly, Asaya is a business we have recently invested in. It's a spin-off from a larger retailer down in Brazil, which the parent is actually a Casino, the French grocery chain. But Asaya was the crown jewel of this business. It's a cash and carry retailer in Brazil. For those of you who don't know what a cash and carry retailer is, you can think about it like a large warehouse with large quantities of goods that you can buy at extremely cheap prices. And what we love about this business is this is a business that has been the leading player in the space for a long period of time. It grows its stores at 10% plus. Its sales have been growing at 20% plus for over 10, 15, I think it's been about 12 years. And really they've been able to create very significant scale and cost advantages and drive operating returns in excess of 40%. And what we love here is these guys turn inventory much faster than anyone else in the market. And that's really what enables them to not only drive the cheapest pricing to the customer, but also the highest returns on their segment. This also is a business in terms of that alignment feature. What we love here is the CEO has been, even though it's a spin out recently, this CEO has been running this business for 13 years. And now his compensation is going to be much more directly aligned to the business than it had been historically. So you have a proven executor who will be more aligned than he used to be. And so again, in terms of sourcing, right, what's interesting for us is this is a high quality business in Brazil, but it was spun out at a distressed time in the markets, generally speaking. And really no one in the international space is looking at $1 billion retailer in Brazil that was spun out. And I think is exactly what we do. And so I think another example of the kinds of things we're looking at that we think are really interesting in the marketplace. The last business I'll talk about before we get into some other stuff is Intertrust. Intertrust is effectively a services business, similar. So it effectively creates trusts in different geographies. It's a services business. So if you run a portfolio and you need a a corporate structure in the Netherlands or in the Canary Islands or wherever it may be, that's effectively what InterTrust does, set those up and manages those businesses. They're administrator at the end of the day, similar to a couple other businesses we've come across. So it's a very high recurring free cash flow business, long customer relationships, and it's again a high return business given it's a services-based business. The CEO had been there, had laid out an interesting plan, and had not been able to execute on it. And the new CEO came in and did something very simple. He changed the incentives for the sales force to drive much higher incentive-based comp to drive sales, and it's starting to work. And what we loved about this is we're buying this with a 8.9% free cash flow yield, 8.9% free cash flow yield for a business not really growing, but historically, but it's starting to grow 3, 4, 5% now, quarter over quarter. And when we see this and compare it to some of the other businesses, we were buying this business at 8 times EBITDA. Some of the other businesses in their category trade at 20% or 20 times EBITDA, 20 times plus EBITDA, 20, 25 times EBITDA, because they do grow that 5 to 10%. And we believe InterTrust can get there. So not only do we get very good cash flow yield, very good downside protection, but we think the opportunity for re-rating here is massive as you see really the growth start to kick in the marketplace. And I think another example of just sort of a high quality business that's been a bit ignored by the marketplace. And if you're willing to go source it and do the work, just a very attractive opportunity. This is how the fund has performed over the last, since inception. I guess we've been up and running 5 years now. The last year has been obviously a very attractive year, but I think what excites us really is I think that some of those catalysts we talked about really driving the international side where we are very overweight, the non-US side. So we think the future continues to be bright, and I think the fund's performed well over time, but we continue to think the future is quite bright on that front. I've talked about some of our top holdings already. I'll skip this for now, and I'll summarize, and so we can get into some Q&A because I think that'll be quite interesting as well. Again, I think in summary, I think you have an experienced team that's been operating in this space for 13 years, and it's a space in which there's significant alpha generating opportunity over time. I think the second thing I'd like you guys to really take away here is that we really believe that some of the catalysts are starting to form around some of the value opportunities we've been seeing over time, specifically non-US small cap. And we think that it's a really interesting time to look at the space because we think over the next 3 to 5 years, the space could perform really well. As I said, I think we positioned the portfolio quite well, and we're really excited about the names we've been finding and adding to the book. And we continue to think there's a big opportunity for meaningful compounding in our space, in our fund over time. So thank you for listening to that. I'll take a pause now and let Adam read some questions, and we'll go from there. But thank you guys very much for listening.
Thank you, John. That was a very comprehensive update. We do have a few questions that have come through, not that many, but I will start with them. And if you have any other questions as I'm going through, please enter them in the Q&A box. But first question, can you please give us some other examples of how you're taking advantage of attractive valuations in out of favor segments?
Yes, certainly. I think from that perspective, I think we talked a little bit about InterTrust, but I think there's several segments in the business services space where we're seeing businesses that have really been ignored by the marketplace over the last 5 years. And I'd say specifically what we're seeing are names that have had ties to interest rates or interest rate sensitive names that have really been totally ignored by the marketplace given some of the headwinds they faced within a low interest rate environment. So now these companies are very cheap. They have very attractive business characteristics, and they could potentially have very significant tailwinds as you see interest rates maybe tick up a little bit all over the world as the world starts to cope with some of these inflationary pressures. So I think that's one area of the market, Adam, that we're seeing quite a few opportunities.
Great, thank you. Next question, you've been overweight international for some time, and you've explained why you see this as an opportunity that you believe will materialize now. But is there a point where you will simply say the US is a better investment environment?
Look, I think there's, I'm from the US. I believe in the US. I think the US has a really phenomenal economic model, and I feel very fortunate to live here. I believe, but I really firmly believe at this point, I think when I look at valuations, when I look at I think a couple things have happened over time, right? I mean, I think the US, if I look at over the last 10 years, right, really hit kind of the combination of technology becoming more accessible with changes in business models to kind of the subscription model, have really driven some valuation upside here and really meaningful things. And I think some of those things are really starting to just occur in parts of Europe and parts of Asia. So we think there's really a big wave of that hitting Europe and Asia in more niche markets. And so I continue to be very optimistic on non-US equities. We love US equities. If we could find a bunch of very attractively valued US equities, we would certainly invest in them. So, we will always be pragmatic about where we're finding investment opportunities. Right now, they tend to be in Europe and I think, and parts of Asia. And I think we believe firmly in those. But, in 2 years, if the where the non-US equities have ripped and US is cheap, we would be revisiting that certainly. So never say never, but I certainly think the opportunity set outside of the US is very attractive right now.
Great, understood. I'm going to group these next two questions simply because they both have the word implications in them. The first question is, what are the implications of developed markets outpacing emerging markets?
So
I think that actually may mean that actually may refer, because I'm thinking about your slides, you were talking about it from a vaccine perspective. So I think that the person may actually have been asking about the vaccines outpacing.
Yeah, I mean, I think, so if I'll take that kind of on three levels, right? The first is, I would, the vaccine outpacing to me means, so if I look at it kind of on economies have been shut down, or are going to need to shut down, and as vaccines roll out, they open up again, right? I would expect economic growth, the rebound in economic growth in parts of the world, in developed markets, to outpace that of emerging markets. So if you look at kind of an economic growth over the next 12 months, I would expect developed markets to outperform emerging markets on a relative basis. And then I think, what are the implications from an equity market perspective? And I would say that, what we see are parts of emerging markets with very expensive valuation, combined with a slowing economy or a more stagnant economy, isn't a great scenario. And if you combine that with inflation, which always tends to really cause havoc in emerging markets, we believe the backdrop really is for from a stock perspective or a performance perspective, that developed, certain parts of developed markets should really outperform emerging markets over the next 12 to 24 months, would be our view.
Great, thank you. Next question. What have the implications been in your market of the rise in power of the retail investor? Robinhood, traders, subreddits, etc. Does this present an opportunity, or is it a risk that needs to be managed?
I think it's both. And I think it's not, I think what we do, right? We are active investors, and active investors are, what we should be doing is taking advantage of inefficiencies in the market. And I think maybe I'm wrong, but the higher percentage of retail trading and the volumes creates more inefficiency in the market. And on one hand, that's a risk in a short-term environment, right? If you happen to own a stock that's impacted by this, or I guess if you're a short stock that was impacted by some of the craziness we saw last year. But so I think in the long run, it's very good for active investors. But at the same time, I think you have to be aware of the risk it causes. And I think you have to understand, when you're looking at your individual portfolio companies, what's the investor base alongside you? Are you in alongside all these Robinhood guys or whoever it is? And if you are, you have to be aware that fund flows are going to drive the stock in the short term and not fundamentals. So I think it's both, but I think long term, it's certainly an opportunity for active managers.
Great. Two questions to go. Firstly, what is your approach to ESG?
So our approach to ESG, and I think I highlighted how important we feel governance is in terms of our process. So governance for us is really critical in every investment we make. And I think we spend a lot of time thinking about long-term sustainable businesses. And so from our perspective, we always want to be thinking about businesses from a long-term time horizon. And so we spend a lot of time thinking about sustainability of businesses and governance of businesses. Those are two things that are really critical for us. And so that, I think that really encapsulates a big chunk of our ESG thought process. Is we want businesses that are sustainable, that have high governance standards, and we look for that in every investment we make. We don't employ a screen specifically, but it is built into, I think a real compliance with governance is built into our process.
Great, thank you. And the last question, do you see a market correction risk as a material concern, in brackets due to increased inflation, corresponding bond prices, or other factors? The bears are out in force for a US correction, but what is your view on global small caps?
Yeah, I mean, I think, I'll just kind of repeat what I said, is it feels a lot like late 90s, early 2000s to us. And now that I have some gray hair and some spots where I don't have any hair on my head at all, I think it feels a lot like that time period to me. And what I mean by that is I think if you are holding some assets that you really can't justify the valuations, I think you could pay for that pretty dearly in a correction. I think you could see you can see a small correction here in segments of the market. But I think if you look at a vast percentage of listed equities, there's actually some really interesting opportunities out there. And I would say if you look at kind of the 2003 period, there are many segments of the market outside of sort of NASDAQ or tech that performed really well, that didn't receive all this capital that flowed in. And so I think we're in that market where there are going to be pockets of the market that perform quite nicely. And I think there are going to be a few pockets that are really a risk for a pretty severe correction. And so we want to make sure we're positioning ourselves to compound over the 3 to 5 years and really position the portfolio in those attractive areas and really avoid those high risk segments of the market.
Great. And that brings Q&A to an end. John, thank you very much for taking time out of a bank holiday today to chat to us. Thank you everybody else for joining us on this update today. I think my key takeaways really from John's presentation was how the team delivered exactly what we expect from active managers. In an environment of uncertainty, they responded by gathering information. They had hundreds of meetings. They confirmed the valuations of the existing holdings. They evaluated them relative to the opportunities on their watch list. And then they took steps to de-risk their portfolio. And then as the uncertainty declined, the portfolio is being reconcentrated into reasonably priced, high quality businesses with clear catalysts to create and compound value. So my take on that is that is what we expect from active managers. Our next webinar in the series is next Tuesday with the team who manage the Alpha Israel Fund. This is a wholesale only fund, but it promises to be a very interesting discussion about the innovation and disruption that we are seeing in the Israeli tech sector. Thank you very much for joining us. If you have any other questions, please get in touch. We'd love to hear from you. Enjoy the rest of your day.